The email hit inboxes with the usual dramatic flair. A tiny company, a chokehold on materials AI can't function without, 18,000th the size of Nvidia, a backdoor winner of the AI boom, and of course, the promise that most investors had never heard of it. That was the hook. But beneath the marketing smoke was a real company. Neo Performance Materials, trading over the counter as NPMF, positioned in the rare earth supply chain. The story being told is compelling. Artificial intelligence needs advanced semiconductors. Electric vehicles need high-performance magnets. Wind turbines need rare earth components. Defense systems need specialty materials. And more than 90% of rare earth processing capacity is tied to China. That geopolitical tension is real. Western governments want supply chain independence. Europe wants alternatives. The United States wants domestic production. Defense contractors want reliability. Neo operates facilities across North America, Europe, and Asia. It recently opened a permanent magnet plant in Narva, Estonia, strategically important for Europe's industrial base. It has relationships with major auto suppliers like Bosch. It manufactures magnetic powders, rare earth materials, and specialty chemicals used in EV motors and high-efficiency systems. On paper, it sits at the intersection of multiple AI infrastructure, EV adoption, renewable energy, industrial automation, aerospace and defense. That's the bullish case. But great stories and great investments are not the same thing. Let's step back. The marketing email first established credibility by highlighting previous recommendations, including giants like ASML, Alphabet, Amazon, and Meta platforms. Those are world-class companies. If you recommended them during a bull cycle, odds are they went up. That doesn't necessarily prove predictive genius. It proves they are dominant firms in expanding sectors. Then came the pivot to something much smaller. Neo is framed as an overlooked, under-the-radar winner. A $450 million Canadian firm positioned to capitalize on the rare earth decoupling from China. Here's where the story becomes more complex. Rare earth materials are strategically critical. That's true, but they are also commodity-linked businesses. Pricing can be volatile. Margins can compress quickly if supply expands or demand slows. Neo is not currently delivering explosive profitability. It is investing heavily in infrastructure and expansion. It is building capacity in a market still in transition, and that costs money. The email emphasizes revenue growth and EBITDA momentum. It highlights disciplined balance sheet management and shareholder returns like dividends and buybacks. But it also admits something critical. The stock is trading on expected future performance, not current fundamentals. That matters. When a stock is up over 100% in a year and approaching prior highs, expectations are already elevated. Investors are not buying what Neo is today. They're buying what they hope it becomes, and expectations are fragile. If EV adoption slows again, if rare earth prices drop, if Chinese exports resume at full capacity, if Western subsidies shift, if geopolitical tensions ease, the narrative weakens. Markets don't punish bad companies nearly as hard as they punish good stories that fail to meet high expectations. There is also a structural challenge. Rebuilding a rare earth supply chain outside China is not simple. It requires mining, processing, refining, environmental compliance, capital expenditure, and long-term contracts. It is capital-intensive and politically sensitive. Neo may benefit from policy tailwinds, but policy tailwinds can reverse with elections, budget constraints, or diplomatic shifts. The CEO's comment that the phone is ringing off the hook signals interest, not guaranteed contracts. Interest doesn't always convert into sustained earnings growth. Investors must separate narrative from numbers. The rare earth thesis is strong long-term. The world is electrifying. Motors require magnets. Magnets require rare earth elements. Defense systems require secure supply. But the market already understands that theme. NIO is not a secret. And then there's timing. The stock has already doubled. It's near all-time highs that were previously reached during peak EV enthusiasm, a period when expectations overshot reality. History suggests that buying cyclical or commodity-linked companies at peak enthusiasm can lead to painful drawdowns. None of this makes NIO a bad company. It may very well grow. It may secure more contracts. It may expand margins as capacity scales. It may benefit from multi-year structural demand. But volatility is almost guaranteed. Small-cap material suppliers tied to geopolitical themes are rarely smooth investments. They swing with headlines, trade disputes, subsidy announcements, and macro cycles. For long-term investors who understand the risks and can tolerate drawdowns, it might deserve a watchlist spot. For momentum chasers entering after a 100% run, caution is warranted. The bigger lesson here isn't just about NIO, it's about how stock marketing works. First, build credibility with recognizable winners. Second, introduce scarcity no one is watching. Third, create urgency, this is rare. Fourth, tie the company to a massive unstoppable trend like AI. Finally, sell the premium product. That formula has been used for decades. AI is today's buzzword. Yesterday it was blockchain. Before that it was 5G. Before that it was the cloud. The underlying themes can be real. The marketing overlay is what investors must filter out. Rare earths are essential. China does dominate supply. Western governments do want alternatives. All of that is true. But investing successfully requires more than a compelling macro narrative. It requires discipline on valuation, timing, balance sheet strength, and execution risk. NIO sits in a strategically important position. It could benefit meaningfully from global decoupling trends. It could expand margins as European magnet production scales. It could secure long-term automotive and defense contracts. It could also face cost overruns, pricing pressure, delays, or policy shifts. The difference between a great thesis and a great investment often comes down to price paid. Buying quality at the wrong price can be just as damaging as buying a weak company. So the story isn't that this is a hidden gem no one knows about. The story is that this is a small but strategically positioned materials company riding a powerful geopolitical and electrification trend already priced for significant growth. The question isn't whether rare earths matter. They do. The question is whether the current valuation compensates you for the risks ahead. And that answer depends on your time horizon, risk tolerance, and ability to endure volatility. In markets driven by AI enthusiasm, chokehold narratives attract attention, but long-term returns belong to investors who look past the marketing, understand the cycle, and buy when expectations are reasonable, not euphoric. NIO Performance Materials may have room to grow. Just don't confuse a powerful story with a guaranteed outcome.